the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Chairman Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect to suggest that that longer-term neutral rate or R-star might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long-run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount, and that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest, and we'd try to keep up with that. And I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. And I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think that there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was, will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember, prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that, and that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're going to watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
Okay, can you hear me now? Can you hear me now, everyone? Okay, I think we've got the mic working now. Just let me know, everyone, if you can hear me. All right, we're in action. So that was just a quick summary of the Federal Reserve's latest minutes of their rate decision. This is my first live stream ever, guys. Holy smokes for the live stream. But yeah, that was very interesting. We'll just see how the markets reacted. So we did see, a sell-off in the Dow Jones, in the S&P 500, and the Nasdaq. And, you could see there that Jerome Powell, he was very nervous. He was kind of dancing around the questions. He didn't really want to, be too specific with interest rates and with tapering. But some huge news and some huge changes that he did announce, or the Federal Reserve did announce. They brought forward their rate hike decision to 2023. So, when the Federal Reserve first started mentioning that they were going to lower interest rates, they were saying, "Come on, guys, take on as much debt as you can. We won't lift interest rates till 2024." But now they're kind of backpedaling. We've had huge inflation data with the CPI coming in at over 5% year over year. We've had the PPI, which is the Producer Price Index, that came in at 6.6%. So again, that's more than 3 times the Federal Reserve's mandate. So they are now saying that they're going to do 2 rate hikes in 2023. And they also increased their inflation target by 1%. So before they were kind of forecasting that, average inflation will be just 2.4%, where now they're saying it's going to be 3.4%. And we had a lot of people trying to ask him questions there about when is he going to taper, but he keeps saying, "Oh, look, we need jobs. We need jobs." And we've got this battle between the Fed, wanting to create more jobs, but at the same time, we've got inflation getting out of control. But something I've been saying is, what's the point of having a job, if you just become a serf, working poor? If, you could be working full time, but if you're only getting, $12 to $15 an hour, and the cost of groceries is skyrocketing out of control, well, then what's the point of having a job? And I guess that's why you're seeing, so many people to be happy on their unemployment benefits. But obviously not everyone. I know some people looking for a job, but many people are happy. And also something huge. This is something I did a video the other day, everyone. And I don't think people really understand how this works. It's very complicated. I'm still learning about this. But the reverse repo market. So in 2019, we had a repo market crisis where the rate people had to pay to borrow money skyrocketed to nearly 10%, because there was a lot of treasuries, US treasuries, but there wasn't a lot of cash. When now we're having the opposite problem with the reverse repo market operations. It's going, over $500 billion a day, where there's too much money in the system, there's too much cash, and all these money markets, and the Fed Reserve did say these money markets are going to face big problems. They're running out of places to park their money, because if they dump this $500 billion into the treasury markets, rates on bonds could go negative. So what the Fed did, and this is something I was warning or predicting that could happen, is they lifted the interest on the reverse repo rate. They lifted that to 0.15%, so that I guess the banks and the hedge funds can have somewhere to park their cash and earn a little bit of interest. And what's funny is, with the Federal Reserve balance sheet, they're saying it's $8 trillion, but they're actually selling around $500 billion worth of treasuries every day. Sorry, but they're not updating their balance sheet. So that's very interesting. They also lifted their forecast for GDP from 6.5% to 7%. So they're showing signs there that the economy is growing much faster than expected. So we're having booming GDP, we're having prices going out of control. This is the first, Federal Reserve meeting since the CPI numbers and the PPI numbers have come very high. So they now can't hide. They're now starting to admit, look, inflation is getting higher. But they also said they can't comment how long transitory is. They're not saying how long the transitory inflation will be. So they've been saying transitory, but it's been close to a year now where inflation has been rising. And he said, I'm not going to tell you when we're going to taper. They kept trying to ask him, when are you going to taper? And he refused to tell the reporters and the people ask him when he will taper. So he was kind of dancing around that as well. So yeah, it was a very interesting brief. We did get the hints, the first hints, because again, Jerome Powell and the Federal Reserve, they're like the politicians. They're not going to just go out there and give you a straight answer. They're going to dance around the questions, and they're going to be a bit funny. So we have to look for hints, in their speech. And so they did provide hints in their speech that they are acknowledging inflation's getting higher. They've brought forward their interest rate hikes a year. And so we are now looking at, high interest rates, higher inflation, like we've all been talking about, everyone. So this was my first live stream, everyone. It was pretty fun. I was going to watch the Federal Reserve's updates anyways, but I thought, let's all watch it together, like one big happy family. So I'll just go to the chat now and just read some of you guys' comments, because it is pretty fun speaking with you guys live. So let me know in the chat, guys, what did you think about the Federal Reserve's update and what's going on in the markets? We can see here the markets are a bit red, but they haven't sold off too much. But really, they're not going to start selling off heavily because the markets that are kind of forward looking, they're trying to price this in before it happens. And so a lot of this talking of tapering or bringing interest rate hikes closer would have already been priced in. Yep, so people are saying that it's admitted inflation is going to be higher. Holy smokes. Cam 35mm says the dire look on Powell's face says it all. So he did look pretty nervous there, and he kept looking down, trying to read the script on what to say when the journalist did ask their tough questions. We'll just have a quick look on what CNBC has to say about this. Just give me one moment. I'll bring this up. Okay, so it says here the Fed moves up its timeline for rate hikes as inflation rises. The Federal Reserve on Wednesday considerably raised its expectations for inflation this year and brought forward the time frame when it will raise interest rates next. And this is what I've been talking about, everyone. I've been warning that inflation is going to get out of control. They're going to have to lift interest rates sooner, and this is going to be, pretty dire for the markets. But it all comes down to, will the Federal Reserve actually do it, or they're just going to keep talking or just keep bluffing? Yeah, we'll taper when things get out of control. But inflation's already out of control and they're not tapering. However, the central bank gave no indication to when it will begin cutting back on its aggressive bond buying program, though Fed Chairman Jerome Powell acknowledged that officials discussed the issue at the meeting. So again, they speak in riddles and tongues, and they're not going to tell you straight, inflation's out of control, we're going to taper next month and start hiking rates. But this is the first kind of language where they're saying they are discussing it and inflation at their meetings. And some other Fed chairs are part of the 12 other central banks. Some of them are debating with the Fed, telling them, like the Dallas Fed chair, saying, look, it is time to start talking or thinking, or even use your mind to start thinking about lifting interest rates. And so it says here, you can think of this meeting that we had as a talking about meeting. Okay, so it says here, this is the meeting about talking about tapering. Powell said in a phrase that recalled a statement he made a year ago that the Fed wasn't thinking about rates. So you heard it here first, everyone. The Federal Reserve is now thinking about raising rates. So, as expected, the policymaking Federal Open Market Committee unanimously left its benchmark short-term borrowing rate anchored near zero, but officials indicated that the rate hikes could come as soon as 2023, after saying in March that it saw no increase until at least 2024, the so-called dot plot of individual member expectations pointing to 2 rate hikes in 2023. Now, what they were saying before is, we're not going to lift interest rates. We're not going to think about lifting interest rates. Now they're saying, okay, 2023. Well, I wonder what's going to happen in 6 months or 3 months if inflation does keep getting higher. Will they bring those rate hikes to 2022? So that's something we definitely have to look at, everyone. Though the Fed raised its headline inflation expectations to 3.4%, well, we all know inflation is much higher than 3.4%. Shadow Stats has inflation at 8.5%, which I think is much more realistic because, again, they changed the way they record inflation in the 80s and in the 90s. This is a full percentage point higher than March projection. The post-meeting statement continued to say that inflation pressures are transitory. Well, it's now been transitory for about a year, so I don't think it's transitory. And what you have to know is, say for example, if prices go up, 50%, and then they fall 25%, and then the Fed says, oh, I told you it was transitory, but prices are 25% higher than they were before. So it's still going to hurt people's purchasing power and people's cost of living. So the raised expectations come amid the biggest rise in consumer prices in about 13 years. So that's crazy, everyone. The biggest rise, and this is official data again, in 13 years. But still, the Federal Reserve saying, you know what, I think we can squeeze out, a bit more. I think we can print a bit more money before we start tapering. So this is not what the markets expected, said James McKinnon, Deputy Chief Economist. The Fed is now signaling that rates would need to rise sooner, faster, and with forecasts suggesting 2 hikes in 2023, this change in stance jars a little with the Fed's recent claims that the recent spike is just temporary. Well, again, everyone, are you happy with a temporary increase in your cost of living? Of course, Jerome Powell can handle it with his $1 million salary and his $10 million portfolio in BlackRock, but a lot of the working class people and middle class, they can't afford temporary inflation. So markets reacted to the Fed's news with stocks falling and government bonds yields higher. So we'll just have a quick look at the US 10-year Treasury. Let's see what that's at the moment. So that's up slightly. It spiked, so we saw a spike there to about 1.66%, but it is pretty. You can see that spike there. It's now at 1.55. So, but again, yield should be much higher, but because the Federal Reserve is buying all these US Treasuries, it's keeping yields low. They're pretty much doing what the RBA is doing in Australia, yield curve control. So we'll go here. Even with raised forecasts for this year, the committee still sees inflation trending to its 2% goal over the long run. Well, again, it's much higher than 2%, everyone. And here's the thing. If it goes up to 6, 7, 8%, and then it goes down to 2 or 3%, well, now inflation is compounding at a higher rate. So it says here, our expectation is these high inflation readings now will abate, Powell said at his post-meeting news conference. Well, again, the damage is already done and it'll be compounding at a higher rate. Powell also cautioned about reading too much into the dot plot, saying it is not a great forecast of future rate moves. Liftoff is well into the future, he said. So again, he's saying, don't panic, guys. The interest rate hikes are, they're going to be later. Don't worry, just keep taking on debt. We'll deal with the issue later. What they always say. And then, the issue comes and then bam, it hits them in the face. They don't know what to do. And then they're going to have to hike rates even higher and make the crash even worse. So Powell did note that some of the dynamics associated with reopening are rising, the possibility that inflation could turn out to be higher and more persistent than we anticipated. So he is now admitting that it is going to be higher and it could be more persistent than anticipated. And he kind of said there that he doesn't really know how long it's going to take. So Powell said progress towards the Fed's dual employment and inflation goals was happening somewhat faster than anticipated. He particularly noted that the sharp rebound in growth that now has the Fed seeing GDP 7% in 2021. So again, we've got booming economy, we've got booming inflation, and I'm sure the unemployment rate will go down once a lot of these unemployment benefits get taken away, and that'll motivate people to get back in the workforce. But unfortunately, a lot of these jobs coming back, are low-paying hospitality or service jobs. So much of the rapid growth reflect the continued bounce back in activity from depressed levels, and the factors more affected by the pandemic remain weak but show improvement, he said. So again, raising GDP expectations. So the statement tampered some of the language of previous statements since the COVID-19 crisis since last year. So the FOMC had said the pandemic was causing tremendous human and economic hardship across the United States and around the world. So Wednesday's statement instead noted that progress vaccinations had made against the disease, noting that the indicators of economic activity and employment had strengthened. The sectors most adversely affected by the pandemic remain weak but show improvement. So investors were watching the meeting closely for statements about the officials seeing the economy undergoing rapid expansion since the depths of the pandemic in 2020. And this is exactly what we got. We are seeing proof that the economy is starting to overheat, especially in the housing market. So recent indicators show that some respects of the US is expanding at the fastest rate since World War II. So again, we're growing at the fastest rate since World War II, but the Federal Reserve is saying, no, we haven't really made a substantial progress towards our goals. That's pretty much his response to every question. Like a robot, we have to make substantial progress towards our goals. But that growth has also come with some inflation. I would say a lot of inflation. And a central bank has faced pressure from various sources to at least start curtailing at least the 120 billion in bond purchase it is making each month. But again, Jerome Powell didn't want to mention when he's going to start doing that. So then that makes people's investments decisions a lot harder because the Federal Reserve isn't being transparent. So at his post-meeting news conference, Chairman Jerome Powell noted the Fed officials had discussions on the progress made toward inflation and employment goals relative to asset purchases and will continue to do so in months ahead. So it'll be very interesting to see what they say in next month. We have to have all eyes on the inflation data for next month to see if they do start admitting they're going to start tapering. So the markets had been looking for the possibility that the committee would address its open market operations where it provides short-term funding for financial institutions. So this is what I was talking about, everyone. The so-called overnight repo operations, aka the reverse repo operations, where the bank exchanges high-end collateral for reserves. So the Federal Reserve is selling US Treasuries to the banks because they got too much cash. But if they put that cash in the bond market, the bond yields in the short term, the 1, 2, 3 month yields are going to go negative. Have been seeing record demand lately as institutions look for any yield above negative rates they are seeing in some markets. So in the US, they're getting very close to negative interest rates. And do you think we will see, negative interest rates in the US at some point? If we do enter into a double dip recession, if the Federal Reserve hikes rates and then crashes the economy, will the next move during the next recession be negative? That'll be very interesting. The committee, like I was saying, guys, on my video on the reverse repo crisis, I was saying that they're going to have to lift rates, otherwise they'll go negative. And I was also saying how the money markets where people put their money to get a fixed income return, they're pretty much losing money and going bust because there's not many places for them to put money to get a yield on short-term income. So the committee did raise the interest it pays on excess reserves by 5 basis points to 0.15%. So again, this is just to keep bailing out the banks, make the banks richer, and get money that they're parking at the Fed, get some interest on that money. And in a separate matter, the FOMC announced that it would extend dollar swap lines. Ooh, this is juicy, with global central banks through the end of the year. So not only is the Federal Reserve bailing out the US, they're bailing out the entire financial system around the world through their dollar swap lines with the Fed. So they're doing this with other central banks as well. So the currency program is one of the last remaining COVID-era initiatives the Fed took to keep global markets flowing. Okay, everyone. So that's the update from the Fed, the latest what's happening in the markets. What did you guys all think about that? I'll have a look what's going on in the chat. So Lee Shepherd Trading saying negative rates are coming. Dollar Milkshakes Theory. Robert saying Australia will be brought by China. And Clemens said, my question would have been, how shall printing even more dollars help create more jobs at all when the financial markets are already drowning in cash? That's exactly right. How is, the Federal Reserve bailing out the financial system, giving money to banks, going to help people get jobs? Yeah, it keeps interest rates low. But, if things aren't looking good for businesses, even if, rates are at very, very low, they're not going to want to invest. So Stefano, no, they didn't raise rates, but what they did do is they brought forward their interest rate hikes from, they said they said before they're going to hike rates in 2024, but now they've brought forward 2 rate hikes in 2023, and it'll be interesting if inflation keeps going up, if they'll bring forward rate hikes to 2022. So someone said gold dumping. Let's have a look at the gold markets. Okay, everyone. So this is kind of what I was warning about, why you want to have some cash. Because, people say, if you want to hedge against inflation, buy precious metals and commodities. But here's the thing, is that's true, but that's only true until the Fed does start lifting interest rates. So, for example, last year when we were going to have all this inflation, it would have been a good bet to get into precious metals. But now that the Federal Reserve is talking about or thinking about lifting interest rates, everything priced in the dollar will go down. And so gold is down around 1.4% at the moment, silver down 1.1%. So again, that's why I was saying it may be a good idea to have some cash on the side as well. So when everything does dip, you can come in there and buy up everything for a discount. So let's look at Bitcoin. Bitcoin's down around 3.22%. So even though, we've had a rally from 31,000 to 40,000 in Bitcoin, we're still kind of in a bearish range here. It's just still kind of hovering around 30,000 and 40,000. And really what it needed to do was break this 42K range or 43K range to break the bearish trend. So until it breaks 42 or 43K, I won't turn bullish again on Bitcoin. And we'll just have a look at the US dollar index. Let's have a look here, see what the dollar's doing. Okay, so the dollar is nearly up 1%. Again, guys, this is what I was warning about. Everything priced in the dollar, when the Fed starts mentioning interest rates will go up, the dollar will strengthen when they lift interest rates. And then things like commodities, like gold, silver, precious metals will fall. And that's why I said, don't sell everything, but you may want to have some cash on the sidelines. Wolf Larson 85, thank you for your for your donation there. Let's have a look at what else some people are saying in the chat here. So Alhesh says, let me ask this. If money we're all paid suddenly isn't worth anything, is it worthwhile going to work now, considering we're all essentially working toward our own slavery? Well, it is still worth something for now, but if the Federal Reserve does keep printing money, does keep letting inflation get out of control, what's the point of going to work if you can't afford the basic essentials? That's why they keep using employment as an excuse to keep money printing. But it doesn't really go to help the working class. It goes to help the financial system. But they're using the working class as an excuse to keep on printing. So Alex thinks they won't lift interest rates. They want inflation. Well, of course, they won't want to lift interest rates. But, if things do start getting really crazy, they may have no choice but to lift interest rates. So Kim Ewan, when will you buy back BTC? Still waiting for 20K prices. Again, not financial advice, not a financial advisor, but yeah, what I am waiting for, because we've never had a drop of 50% plus, and then the bull market continued. So I'm waiting for around 25 to 20K and then I'll be happy to start buying Bitcoin again. But hey, I could be wrong. It could go back up, but all the fundamentals, like I was saying, with the Fed lifting interest rates, everything priced in the dollar, like Bitcoin, gold, and silver, if the Federal Reserve does lift interest rates, are going to fall, and that's what we're seeing right now. So Cam35, thanks for that super chat. So Constantine, lumber crashing. Yeah, I have seen lumber prices have been going down a fair bit. We'll just have a look at the lumber prices. Wow, so lumber has broken $1,000. So it was around $1,700, and now it's down to around $967. So yes, lumber is falling. That doesn't mean inflation is going away. There's just a lot of speculation in the futures market, because these are the future market prices of lumber. But hey, if lumber does keep crashing, then hopefully it'll get cheaper to build a house, because the cost to build a home has been getting out of control lately. Okay, everyone, I think that'll do now for this. This was my first live stream. Sorry about the internet cutting out. I'm going to have a conversation with my internet provider to make sure the connection is more stable for next time. But I've really enjoyed this live stream with you all. It's good chatting with you live and seeing all your comments in the live stream. So hopefully I can do a few more live streams in the future. But again, everyone, thanks for watching, and I'll see you all in the next one.